If you have been investing in the Singapore market for more than a year, there is a very high chance you have felt the sting of what we call a yield trap. You know exactly how this story goes because it is almost a rite of passage for dividend investors here. You are scanning the market, maybe looking for something to boost your passive income, and you see a REIT. It looks incredible, it is trading at a low price, and the dividend yield is flashing a juicy 8%. Now let's pause here. 8%, that looks perfect. It pays significantly more than your CPF ordinary account, which is giving you 2.5%. It pays more than your CPF special account at 4%. It even beats the Singapore savings bonds. It feels like a no-brainer. So you buy it. You put $10,000 of your hard-earned savings into it, thinking you have secured a steady stream of passive income. But then, 3 months later, reality hits. They announce a rights issue. For those who might be new to this term, a rights issue is essentially the company coming back to you, the shareholder, and asking for more money just to keep the business floating or to pay off debt. It is a demand for cash. Or maybe they announce a dividend cut. Suddenly, the stock price collapses by 20% in a single week. That 8% yield you were chasing, it just cost you 20% of your capital. So, is this a trap? Yes, it is the classic definition of a yield trap. And this is the nightmare scenario for every Singaporean retiree. Think about it. If you are retired, you do not have a monthly salary coming in to patch up these mistakes. You cannot afford to lose your principal just to chase a coupon. If you lose 20% of your capital, you have to make 25% just to get back to break even. That is a hole that is very hard to dig out of. Most people try to avoid this by reading 200-page annual reports. They try to be forensic accountants. But let's be honest, you do not have time for that. You have a life, you have a family, you have hobbies. And honestly, sometimes the red flags are buried so deep in the footnotes of those reports that even the professional analysts on Shenton Way miss them until it is too late. I used to be that guy. I used to spend hours digging through balance sheets, trying to calculate gearing ratios and interest coverage ratios manually. But I don't do that anymore. Now, I use a 10-second safety first protocol that instantly filters out the trash. It is a ruthless filter. And today I am going to show you exactly how I do it using institutional grade data. But before we get into the mechanics, let me introduce myself properly so you know who is speaking to you. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. We are also thrilled to welcome our growing community of over 48 YouTube Premium subscribers and 22 paid Substack members. My focus is always on regional and global trends to give you that broader context. Now let's get into the core concept, the safety first protocol. Before we dive into the steps, you need to understand one fundamental truth about the stock market. Not all dividends are created equal. I will say that again. Not all dividends are created equal. A 5% dividend from a company like DBS is fundamentally different from a 9% dividend from a struggling US office REIT. Why? Because one is likely funded by growing profits and real cash flow from a dominant banking franchise. The other might be funded by debt or by selling off assets, which is like selling the furniture in your house to pay the electricity bill. It is unsustainable. To tell the difference instantly without needing an accounting degree, I use the Investing Pro Financial Health Score. Think of this as a credit score for companies. You know how you have a credit score when you apply for a housing loan? If your score is bad, the bank won't lend to you because you are high risk. This is the exact same concept, but for the companies you want to invest in. The algorithm aggregates over 100 different metrics. It looks at cash flow, which is the actual money moving in and out. It looks at debt, specifically how much leverage they are using. It looks at profit margins and growth. It takes all this complex data and compresses it into a single easy-to-read score from 1 to 5. Let's break down what these scores mean, because this is your first line of defense. If a company has a score of 1 or 2, this is what I call the danger zone. These companies are statistically more likely to cut their dividends or, in the worst case scenario, face insolvency. If you are holding a stock with a score of 1, you are essentially gambling. If the score is 3, that is the safe zone. It means the business is stable, The fundamentals are decent. It is not amazing, but it probably won't blow up in your face tomorrow. If the score is 4 or 5, this is the sleep well zone. These are companies with fortress balance sheets. They have cash to spare. They can weather a recession. They can pay you your dividend and still invest for growth. This leads me to Iggy's golden rule. I never buy a stock with a financial health score below 3. I do not care if the yield is 10%. I do not care if it is 12%. If the health is a 2, it is a trap. I walk away. So let's look at step 1 of the protocol. I call this the trash filter. The moment I look at a new stock, before I check the yield, before I check the chart, before I even read the news, I look at the health overview. Let's say you are looking at a popular REIT. Maybe your friend recommended it at the coffee shop. The yield is high, maybe 7 or 8%. But you pull up the data and the Investing Pro Health score is flashing a red 1 out of 5. What does that tell you? It tells you that despite the yield, the engine is broken. It might be drowning in debt or its cash flow has turned negative. This single number saves me hours of research. I don't need to read the annual report to know there is a problem. If I see a 1, I close the tab. Next, I move on. Now, you might be asking, how accurate is this really? I didn't just guess at these numbers. I checked the Investing Pro models, and the algorithmic scoring has consistently flagged distress in major REITs months before they cut their dividends. It is based on hard data, not opinion. And listen, if you want to run these numbers on your own portfolio, stop guessing. I've arranged a special deal for you on Investing Pro. The same institutional data are used in this analysis. Use the link below with code INVESTINGIGUANA for up to 50% off. Do not fly blind when you can have a radar. Let's move to step 2. This is arguably the most important step for dividend investors. I call this the silent killer check. This is specifically looking at cash flow versus accounting profit. Here is a secret that Wall Street doesn't usually explain to retail investors. Dividends are paid from cash, not from profit. Let me explain the difference. Accounting profit or net income is an opinion. It includes things like revaluation gains. For example, if a REIT owns a building and they say the building is worth more this year than last year, they book a profit. But did any actual cash enter their bank account? No. You cannot pay a dividend with a revaluation gain. You can only pay a dividend with cold, hard cash. A company can show massive accounting profits on paper, but actually be bleeding cash in reality. This is exactly what happened with several high-profile REIT collapses in the past. They looked profitable, but the cash tank was empty. So in Investing Pro, I click on the Financial Health tab, and I look specifically at the Cash Flow Health subscore. You are looking for a very specific danger pattern. Here's what it looks like. You see Profit Health is a 4 out of 5. That looks good, right? But then you look right next to it, and Cash Flow Health is a 1 out of 5. This is a disaster waiting to happen. If you see this divergence, run. Why? Because it means the company is borrowing money or selling assets just to pay you that dividend. That is unsustainable. It is like using a credit card to pay off your mortgage. Eventually, the music stops. The banks cut off the credit line. And when that happens, the dividend vanishes and you are left holding the bag. So, does this really impact your returns? Let's pause and look at the math. This brings us to step 3, the case study. Let's look at a real-world example of why this matters. I want you to imagine 2 industrial REITs. Let's call them REIT A and REIT B. REIT A is the trap. It has a dividend yield of 7.5%. That sounds great. But when we look at the health score, it is a 2 out of 5. And when we look at the cash flow trend, it has been declining for 3 years. Now let's look at REIT B. This is the compounder. Its yield is lower, let's say 5.2%. But its health score is a strong 4 out of 5. And its cash flow trend has been rising for 3 years. The amateur investor looks at this and buys REIT A. Why? Because 7.5% is a bigger number than 5.2%. It is simple math, right? They want the higher income today. But the pro investor buys REIT B. Why? Because REIT A is priced for distress. The market is smart. The market expects a cut. The reason the yield is so high is that the share price has dropped because investors are scared. When that dividend cut finally happens, the share price drops another 30%. Your total return becomes negative. You have lost money. REITB, however, has the cash flow to raise its dividend next year. Because they are generating real cash, they can increase the payout so that 5.2% yield grows. And because the business is healthy, the share price goes up. Your yield on cost goes up. Your capital appreciates. I checked the Investing Pro peer comparison tool, and it shows you this side by side in seconds. So you can instantly see that with REIT A, you are taking massive extra risk for a tiny bit of extra yield. It is not worth it. And again, I didn't just guess at these numbers. I checked the Investing Pro models, and the algorithmic fair value pegs these healthier companies with much more upside potential. If you want to run these numbers on your own portfolio, stop guessing. I've arranged a special deal for you on Investing Pro, the same institutional data I used in this video. Use the link below with code Investing Iguana for up to 50% off. Now let's move to step 4, the trend check. It is not enough to just know where the company is today. You need to know where it is going. Is the company getting better or worse? Investing Pro allows you to see the health score trend over time. This is critical because businesses are dynamic. They change. I look for a green flag. This is where the score moved from a 2 to a 3 over the last year. This is a turnaround play. It means management is fixing the problems. Debt is coming down. Cash flow is improving. This is a great time to enter. On the flip side, I look for the red flag. This is where the score drifted from a 4 down to a 3. This indicates deteriorating fundamentals. Maybe the industry is facing headwinds. Maybe management is making bad acquisitions. I want to buy companies on the way up, not on the way down. I want to catch the wave, not the falling knife. So what does this mean for you? Why does this matter for your retirement? If you buy a company that is deteriorating, you are fighting gravity. You are hoping for the stock price to go up while the business is getting worse. That is a losing battle. But if you buy a company with an improving trend, you have the wind at your back. Even if the market is flat, a company that is getting healthier will eventually be rewarded by the market. So let's bring this to a verdict. You need to stop guessing. That is the bottom line. You wouldn't buy a used car without checking the engine. You wouldn't buy a house without checking the foundation. So why would you buy a stock which represents your financial freedom without checking the financial health? This safety first protocol takes me less than 60 seconds. I log in, I type the ticker, I check the score, I check the cash flow, I check the trend. That is it. But those 60 seconds have saved me thousands of dollars in avoided losses. So here is your action plan. I want you to do this today. First, open your portfolio. Look at every single stock you own. Second, run every single stock through the financial health check. Third, if you find a 1 or a 2, investigate immediately. Do not panic sell, but investigate. You might be holding a ticking time bomb. You need to ask yourself, why is the score low? Is it a temporary blip or is the business model broken? A financial health score of 2 is a clear warning sign because it tells you this business is sitting in the danger zone of the model with weak balance sheet strength, fragile cash flow, and limited profitability support behind the dividend. If you see this, any shock like higher interest rates, falling revenue, or just one bad quarter could quickly force dividend cuts or even raise solvency risk. If you want to run this safety check on your own stocks right now, don't pay full price. I've secured a special deal for the Iggy community. Get up to 50% off Investing Pro with the code Investing Iguana. The link is right there in the description. This was just module 1 of our Investors Toolkit Masterclass. We have more coming. In module 2, we are going to talk about the fair value framework. I'll show you how to ignore analyst hype and find a real entry price for blue chip stocks like DBS and OCBC. In module 3, we will cover the Dividend Hunter Screener. I will show you how to build a watch list of hidden gems in under 60 seconds. Make sure you are subscribed so you don't miss module 2. If you found value in this, share it with a friend who is investing for their retirement. Thanks for watching, and I'll see you in the next analysis.